Look for companies that can reinvest at high rates of return. I think these things are going to go from being kind of negative for the market when CapEx is high. Like once you believe the returns in the CapEx, you actually want to see high CapEx because you know the returns from that is going to be spectacular.
We also want lower volatility than you, but while this situation is here right now, we are trying to take advantage of it as much as we can. And bear in mind, we're not talking about small cap companies here that are not liquid. These are huge, trillion-dollar companies that are quite easy to trade in and out of.
It's clear the semiconductors will make a lot of money, but it's also clear that money is going to deliver great returns at the hyperscalers. And I think that dam all broke kind of last week. So I think it's highly likely that both of these buckets do exceptionally well.
In the event that you had this amazing model, you wouldn't be selling your computer externally, right? So, like, how do you square that circle? And now all of a sudden, instead of focusing on all of the space launches and how they're going to make amazing money from Starlink, it's actually going to be an AWS type of business going forward. And the next thing is data centers in space.
We're going to start the day just with a quick couple of slides from Jacques, just to sort of set the scene on some of the stuff he'd like to chat about. And then we're going to have the very traditional panel discussion. I've got Dave, Jacques, and Justin with me today. And I must say thank you all for being here, because I know at the moment clients are keeping you busy. They're probably not the happiest human beings on the planet. And I know that you're playing psychologist more than anything else at the moment, so we do appreciate your time. I'll hand over to Jacques.
Morning, everyone, and welcome. So I think we're all extremely lucky to be alive, because this is undoubtedly, I think, the most interesting point in the last 300,000 years that humans have walked the earth. We've been going on pretty relentlessly about AI and the very rapid progress we expect to see happening. And the amazing thing is that things have moved even faster than we expected. So if we look at the last 6 months this year, the progress has just continued to accelerate. And I think because of that, 2026 will go down in history as a very pivotal year for the human race, because it's the year that the singularity started. If we look at what the singularity is defined at, it's basically when AI gets good enough that it passes the level of the best humans in some fields. And because of that, it can work on the AI models and effectively self-improve and massively accelerate the rate of progress. And if you look at pretty much all the leading figures in the field, the people at the AI labs, the people in San Francisco, they believe the singularity is here. So why do they see that? So this is, I think, a few of the key pointers we've seen happening in the last 6 months alone. So firstly, on maths, AI, all the leading AI models now score a perfect score at the International Maths Olympiad. This is the hardest human maths Olympiad in the world. There's like 5 people in the entire world on average that can get full marks for this thing every year, and now all the AI models are doing it after vaguely being able to understand the problems only 3 years ago. On coding, we now beat the best humans on head-to-head performance. And then the other big improvement this year is that agentic AIs can now run for very long periods without human intervention. So it can do multiple days. We've got some tasks in our office that can run multiple days now without human interference. At the AI labs, they've got projects running several weeks now without humans getting involved. So you've got an unbelievable person here, or an AI that's like a person that can be given a massive project. Sometimes it's like a year's worth of work that it can just run straight for 2 weeks and finish it. Further on acceleration, I think you can see just on the rate of model announcements. There's new frontier models almost every week, either an open source model or a new model from the major labs. We're just improving very, very rapidly. And finally, on the danger side, some of you would have seen this incident in the last few weeks. There's actually been multiple incidents now where the AI has been given a closed computer in which to do certain tasks to see how good the AI is. The AI, to solve the problems it's been given, figures out the easiest solution is, let's actually hack out of my box that I've been in, go to the internet, hack into the company that set the problems, and try to find the answer on their servers, which is really not something, this is stuff of sci-fi books that's actually just happening in real life. So it clearly tells you we're dealing with something else now than a bot that can just be spoken to and answer some basic questions. So obviously, there's AI progress, and then it's how it impacts markets and the economics of it. And I'm going to give you our basic framework for how we think about it right now. So this is a slightly complicated slide, but it basically explains to you how we see the flow of money working through the AI value chain. So firstly, on the left for you, we've got the businesses using AI. This is our business. This is some of you using AI. This is large companies, large banks, Meta, etc., using AI. So they are the users of the AI. They want to either improve efficiencies in their business, maybe move faster on software development, maybe enhance revenue. So they pay large amounts of money, like we do as a business now, to Anthropic and to OpenAI as the frontier labs. And I've just simplified it. There's really two companies dominating it. We can see that flow of funds is massive, because if you look at Anthropic's revenue, I think 18 months ago at the start of 2025, they were at $1 billion annual revenue run rate. We then all heard about the fact that it grew 10 times last year. It ended the year at about 9 or 10 billion revenue run rate. So within a year, 10 times growth. And that's then gone to, I think the latest number we've seen is about 80 billion revenue run rate. So even off 10 billion, which is a gigantic number, in 7 months alone, it's probably 8x again to 80 billion. So there's a massive money flowing there from the real economy to these labs. What the labs then do is they send that money to the large hyperscalers, Amazon, Google, and Microsoft, that host these big data centers for them. And then some money they send directly to the semiconductor companies. They're trying to buy some of their own compute. But I think right now more of it goes to the hyperscalers. So all that money going to the labs, that all flows onto the hyperscalers. And for now, what are the hyperscalers doing? They're taking that money coming in, plus they're taking all the free cash flow, like Google. They take all the free cash flow they make in their search business. Amazon, they take all the free cash flow they make in their retail business. They take that plus the money from the labs and they send that all to the semiconductor manufacturers. So there's this gigantic value transfer in the real economy. So our play for this year was to basically own number 3 and 4. That's towards the bottom end of this chain. To say, track where the money's going, that's where the profits are going to be. I think where we were right, and that's been the biggest winner for this year, is owning the semiconductor companies. The benefit for them is they don't have to send the money on. The money just turns into profits for shareholders, right? So those shares have done exceptionally well because there's this gigantic gush of money flowing to them. They sell their chips and they bank that money. They can use it for dividends, for share buybacks, and also for expanding capacity. So that's done very, very well for the funds. You guys would see where we're kind of up low single digits for the year in the various funds. So it hasn't been the best kind of 6 or 7 months so far. And the reason for that is we've done very well in semis, but unfortunately been too early in the hyperscalers. Because for the last 7 months, the market has just seen these companies are suddenly spending all their amazing free cash flow and they're sending it on to someone else. They're not sending it to shareholders for dividends and buybacks. It's being on-sent. The reason we have owned them, and I think we will be proven right, is we think they will generate amazing returns on that investment. I'll just show a little bit in the next few slides, and then Justin can cover it during the Q&A. But I think with hindsight, what we could have seen is, for the first part of the cycle, maybe just own the person at the very end of the value chain that's getting all the cash flow. We didn't know how long the market would take before they saw the value in the hyperscalers. Clearly, for 6 or 12 months, they doubted whether the returns will be there. But fortunately, last week, these amazing results from these companies, I think clearly proved beyond a doubt that there will be amazing returns in the space. So that's kind of the framework. Obviously, what's going to happen is I think the market expects Anthropic to maybe list in the second half. So we can then look at potentially investing in option number 2 or bucket number 2 down the line if it becomes available. Right now, you can obviously not. It's not available in the listed space. And then eventually, real-world companies will also see the benefits. But I think that'll come through more slowly and steadily on various companies. We're looking for that right now. But I think with when this flow of funds happen, you want to start at the bottom and then slowly move up to the top layers of the chain. So just very quickly on the hyperscalers, what's happened. And this is basically what we expected to happen, and the market just took a while before they started pricing it in the shares. You can see this is AWS. They're the largest of the 3 hyperscalers. This is their cloud compute division, their revenue growth per annum. And you see for 23, 24, 25, they were going at like high teens growth, which is reasonable. I mean, we like companies growing at 20%. And then they started spending the CapEx kind of from middle last year. The numbers started getting really big. And the revenue started accelerating, but I think the market felt, geez, if you go from 20 to 24% revenue growth, that's not really enough for this crazy amount of cash you're spending. But then it went to high 20s. We thought the market might pay attention to that. But then obviously this last quarter was spectacular, a full 10% percentage point acceleration in 1 quarter alone. If we look at Google Cloud, the picture is even more staggering. They were a smaller business. They were growing a bit faster. They were growing at about 30%. But you can just see there the revenue acceleration is absolutely staggering. So I think what we'll cover in the panel is speak a lot more about AI, but also talk through some of our other themes, being South Africa and some kind of precious metal exposure. If I look at our job as fund managers, we want to take maximum advantage of the opportunity set given to us. I think in the first half, or let's say the last seven months, the SA market didn't present the opportunities we had hoped. It was just kind of a sideways to down period for some shares, some up, some down. Unfortunately, the war took away the exciting picture for SA. Again, we'll cover that. There wasn't really great opportunities in commodities. And if I try to measure ourselves again on the previous slide, I think we did very well to take advantage of the opportunities in bucket 4. With hindsight, we could have obviously done even better and taken bigger positions earlier. But unfortunately, we were too early in our timing in bucket number 3. I think the picture changes very, very quickly. It basically started last week, but I think that's probably going to be the story of the second half, and we'll try to get into that into some more detail. Okay, guys, you can come up. Let's take some questions and discuss this.
Jacques, I'll start with you. Just setting the scene from a bigger picture. The last time we did this actual panel was at Investor Day, and the 3 things we were very constructive on at the time was obviously the AI bucket, but secondly was South Africa, which I think at that time was the biggest of the 3 buckets in terms of exposure, and then thirdly was precious metals, so gold and to a lesser extent platinum. We were just talking about it before we got up here. I think we did that panel on the 20th of Feb, and Mr. Trump decided to destroy all hope for the South African bucket shortly thereafter by dropping bombs all over Iran. But it obviously hasn't been a straight line for all 3 buckets. So maybe we can just chat about what we felt has worked, what we felt has not worked, but also how we've responded in the portfolio over the last 6 months.
So look, the main thing that I think changed both of those narratives was the start of the war. And I'm actually going to hand over to Dave. He's been our point man doing all the calls on the Hormuz Strait, so he's best positioned to cover that. And I can always add at the end on what we've done on positioning.
Yeah, I think when we sat here in February, I think the runway for South Africa was really exciting. We had muted oil prices, which was providing a tailwind. And we had very strong precious metal prices, both in gold and in the PGMs, particularly so in the PGMs. So we could see a massive foreign exchange surplus coming into South Africa. It would have meant a continued strong rand. It would have meant quite acceleration in interest rate cuts. And as you know, I think I said myself, I probably was as bullish on the SA outlook as I'd probably been in the last decade. Structural reforms were starting to happen, so it really looked like we were in a real launch pad to getting some real growth into South Africa and probably some quite exciting equity returns. As Ellen pointed out, not sort of, they say a week's a long time in markets, and that proved to be true, but obviously then the bombing of Iran really did change that situation. And again, as we sit right now, I think it's difficult to comprehend just how aggressively that situation actually swung around. If we look at where we were there and where we are now, the foreign exchange flow has actually changed on spot prices by about 230 billion rand on an annualized basis. And again, a lot of that's come from the fuel price increase. We've gone from sub 20 diesel to its spot, it's going to be above 30 rand. So that's a 50% move in diesel prices. And obviously that is such a indirect negative effect on South Africa and its cost base. We only have we probably have a third of our product that is manufactured locally through Sasol and the refinery in Cape Town, and 2/3 of our product is actually fully imported. So just a really, really negative scenario for South Africa will be just write checks and get no secondary benefit out of that. So I think when we sat here, we had about 42% of our fund was in South African shares, really felt that we were well set up. And obviously on that change, we then had to pivot relatively quickly, which we have done. We've cut our SA exposures to just under 30% at the moment. I think we still have got some selected exposures in financial. We've got some nice exposures in food producers, a little bit of exposure in retail. And I think what we're looking to do now in South Africa is just stick with the A management teams that have got some earnings visibility in this market, who are executing well. So the South African story is from here on very much data dependent and depending on what happens with the war. So we are still ready to see what happens. If the war did miraculously get solved, then again, it's a very difficult situation. I mean, all it's going to take is 3 or 4 guys in a cave with a few rocket launchers to close the strait. So I think that is the real situation here that people haven't really grasped, that it isn't really a very easy war to end. I think that the disruption is very easy to sort of perpetuate. But if we did get some resolution to the war, we would still probably be more constructive on South Africa, because that situation would hopefully sort of reverse back out. But again, it's a situation now where it's on again, off again, and we really don't want to be caught trading the thing on an intraday basis, depending on what Trump's latest tweets are. So we've got what we consider to be right now a pretty decent holding in South Africa in selected companies where we feel we have earnings visibility. And then depending on where the war goes from here, whether it gets solved or not. But if it did get solved and solved on a lasting basis, we would still feel that the South African story can come back into play relatively quickly. I think we are still relatively well set up. And I guess the thesis that we had in February would have just been delayed rather than totally scuppered. So I think that's kind of where we sit on South Africa right now. We have pivoted down, and I think we're waiting to see a lasting resolution to this war in order to potentially put South African equity content up a little bit.
So just to add to what Dave said, I think at the start of the year, we were close to 40% net exposure in South Africa, and it was split between retailers, banks, we liked some insurance businesses, food producers, and then some stock-specific ideas. I think we've brought things down across all the buckets, but mostly retail, because I think there we've clearly seen the food price impact and also the interest rate story where you're expecting declining rates, now you've had rate hikes. I think the most clear direct impact is on the retail. So that we've cut quite substantially, but overall SA is taken from about 40% to 30%, partly because the SA story is delayed, but also as the years progressed, I think we found more and more interesting opportunities offshore that seem to be a better place to put that capital while the SA story is somewhat uncertain.
Dave, maybe just carrying on from there, the second part of that thesis was obviously the high gold and platinum prices and what that was doing for the fiscus. How are we seeing that? I mean, gold and both have obviously derated quite materially. Do we think that is a short-term event, or structurally are we expecting it to remain lower for longer?
Well, I think if we look at what our gold and platinum exposure was when we sat here in February, it was around 10% of the portfolio. We have halved that to 5% at the moment. It's predominantly gold. Gold's probably 4 of the 5. We still think longer-term gold is something that certainly with the world disorder as it is right now will come back into vogue. So we are still relatively constructive on that. But there's no doubt while the oil... I mean, gold should be a risk on a war type of asset, but it's reacting right now like it's a risk-off asset. So whenever we get a de-escalation in the war or potential truce, then we're seeing gold starting to rally. So longer term, we're happy with our positions at the moment. I think we've got an appropriate, but not certainly outsized position. So we are still constructive, particularly on gold. The PGMs are slightly different. If oil prices continue to be high, we're talking about potential world recessions on the industrial side, and obviously the PGMs are still very much an industrial metal versus gold that is a kind of store of value. So we're quite happy where we are right now. The prices are obviously still, particularly on the platinum side, a bit higher than they were last year. There is still a slightly positive story to South Africa, but again, more than offset by the negativity out of the oil price and what we're paying for that. So we think we've probably got an appropriate position there at the moment, but I think if the war had to end, I think we would see gold starting to run a little bit. And we've seen that the last couple of days where the crisis seems to have been, again, somewhat de-escalated, but for how long that lasts, who knows?
I mean, if we go back, Alan, to the two key things making us optimistic medium term, in my eyes, is probably government deficits globally. I think governments have just figured out there's just no reward as a politician to run a balanced budget or to run a budget surplus. Spending is better for the economy, you boost the economy, you have stronger economic growth, and you can give handouts to the people that vote for you. So politicians have just figured this out. No one wants to be the guy that is conservative, runs a surplus, but then causes a recession or has less handouts, because the next guy that's going to come in is just going to use the fact that there's more flex in the budget and he's going to spend and buy more votes. So I just don't think that changes. Deficits will continue to be high. Debt to GDP will just continue to go up almost everywhere. So that's the one part of it. And the second part of it, this geopolitical uncertainty building globally, the lack of trust between major economies, what Trump has done to US relations with Europe, and also this US-China conflict. And I think in time, it'll just be when countries have foreign reserves, there will be less and less trust. That means China, do they want to own $1 trillion of US treasuries, or would they rather have that in gold where the US can't use that as leverage against them? Certainly they're going to in time own more and more gold as part of that mix. So if you think about those two things, that justifies like basically some medium-term uptrend. But then at the short term, like gold is a risk asset, so it can go above or below that trend. So even if we think it's an uptrend, it's very hard to know exactly what the trend is and exactly how high it is. And clearly, maybe in Feb we somewhat overshot that, and I don't know if we're on the line or slightly below it now, but I think it's still something we're going to look at longer term as a part of the portfolio, and we might upsize it again when we're more confident that kind of we're through the short-term volatility.
And just a further point there is China's consistently been a buyer of gold just literally every single month. So as the price gets drawn down, you see them actually increase their purchases. So there is no doubt that China is taking a strategic view on gold. They obviously want to be a reserve currency in time, and there's no doubt that they feel having some of that backed by gold reserves is something that's going to stead them in good stead.
Josie, maybe just before we move on from South Africa, a question here regarding property markets and exposure to kind of the property sector. I mean, we don't have much at the moment. Maybe give your thinking on that.
We don't have much. We've got zero. If you look at how the property market has behaved in the last couple of years, I think the biggest anchor that has been these bond yields in SA. So they've moved from sort of 10.5 all the way to about 8.5 today. And the property companies have actually moved by more than what the bond yields have moved by on a positive sort of basis. So we had that fortress position, which was extremely big, but that was a very bottom-up type of opportunity where we really had to get our hands dirty and work with the management team to unlock value that was clearly there. Subsequent to that, I just don't really see a lot of value in many of these other names that are trading at mid-7s, mid-8 sort of type yields with growth rates in the 4s and 5s. It's really not that attractive, all things considered. So we don't have anything in SA property at the moment.
Maybe if we move now just to the hyperscaler segment, which has obviously been a drag on the portfolios over the last 6 months. I mean, Jacques obviously given us our thinking in terms of why we want to own these businesses. It certainly has felt like those companies have been the funder of choice for investors moving into the kind of semis and memory space. Given the results that you've seen recently, and I mean, just generally the kind of the valuation lens you're putting to this thing, why do you see value and like, I mean, what's making you optimistic about these businesses?
So I think Thursday night at 10:30 or whatever the number was when Amazon reported their results was a very, very important period for everybody in this whole hyperscaler build-out. Jacques mentioned the growth rates that we're seeing out of these companies from a revenue perspective, but that means absolutely nothing unless you're generating very good returns on your invested capital. If you're generating 40%, 50%, 80% revenue growth, but it's coming on at 5% margins relative to 35 historically, that's obviously really bad. So there was a narrative that is out there that over time a lot of these hyperscalers are going to start looking like quote unquote yellow equipment rental businesses. And we've done a hell of a lot of work over time to just sort of understand the unit economics of building one of these data centers and how that sort of manifests in time. And we've had a lot of conviction, but the market just obviously has not believed a single thing for the last 6 months. When we had this Amazon call on Thursday night, Andy Jassy sort of reminded the market or told the market for the first time, where they'd been quite coy for the last 2 or 3 quarters. He said, look, we've got payback periods on this capital of 2.7, 2.8 years for every one of the data centers that we're standing up. There's a lot of flexibility in terms of, if the demand is not there, you're just not going to be putting additional capital into the ground. You can turn off your commitments and all those sort of things from a chip perspective. So, that 2.8 years payback period translates into a return on capital employed, a return on assets of roughly 20 to 23% per annum, which is a very respectable sort of number on an ungeared basis. And I think when the market saw that and they listened to the Microsoft call, where they also mentioned that the base of demand was becoming a lot more broad-based. It was not just OpenAI and Anthropic that was generating all this revenue growth. It is also customers on the ground I think Satya Nadella mentioned a number on Microsoft's call of, I think, 25% growth quarter on quarter of revenue generated from non-hyper or non-model frontier model companies. So it is becoming broader based. It is becoming a lot clearer to the market that you're generating sufficient returns on invested capital. And it's interesting to see somebody like Berkshire Hathaway put $10 billion into Google recently, where this perhaps looks very similar to some of their railway businesses in the past that they've put money into, where you've got this runway to invest for a very, very long period of time at decent returns on assets, but on a sort of a geared basis, you'll be able to grow your earnings for years and years and years to come. So I think we've got more confidence now than prior to last week that we're going to see growth numbers in the sort of mid-30s for many of these hyperscale businesses that we've got exposure to. So the only missing piece, I suppose, that Jacques didn't mention was perhaps on Anthropic and OpenAI, which are obviously very, very big customers for all of the hyperscalers. And the extent to which their businesses are sustainable is also very, very important. And some of the recent numbers that we've seen out of Anthropic suggest that they are already profitable. They're generating 90% gross margins on the incremental software type spend that people are spending money on over there. And they are profitable and generating free cash flow. And since OpenAI has released their recent models, we're seeing a very similar trend for that business, where I think they are very quickly getting to a point of profitability. So I think that is very, very sustainable for this entire value chain. And then the important thing I think now that we are very hopeful for is we're going to stop seeing this negative correlation between semis and hyperscalers, and it's actually going to be complementary, because the hyperscalers are very much sustainable. The guys at the model layer are generating sustainable profits, and that is going to support the build out from a demand perspective with all the semiconductor names over the next 3 to 5 years.
I mean, Justin, maybe to add to that, so both Google and Amazon, I think this year is going to spend around, let's say, around 200 billion of capex each. So when those numbers initially came out, the market sold off because they said, shit, you're spending $200 billion, that could be used for buybacks or shareholder returns. But as Andy Jassy has made it clear now, a very rough picture is that 200 billion a year generates 70 billion of free cash flow for the company on the 5-year contract. They've pretty much done back to back when they spent that. So if you spend 200 now, after 3 years, you've got back 210. So you've fully paid off your 200. Year 4 and 5, you get another 70 in each of those years. So you're up to like 150 positive. And after year 6 and 7, maybe the rates on these chips drop slightly, but you're still going to get cash from them year 6, 7, 8. So that's a pretty amazing investment. And what we always really like is companies that can invest back into their businesses, significant amounts of capital at high rates of return. That's exactly what Justin mentioned, why Berkshire is probably looking at Google now. This is exactly how they built Berkshire. Look for companies that can reinvest at high rates of return. So I think these things are going to go from being kind of negative for the market when capex is high. Like once you believe the returns in the capex, you actually want to see high capex because you know the returns from that is going to be spectacular. Like you're spending 200 billion rand of free cash flow to buy like 70 billion of free cash flow for the next year, which is just an amazing trade-off for any company. And the fact that it pays back so quickly, like in under 3 years, means there's not a whole lot of risk. You basically need Anthropic or OpenAI to somehow go bankrupt in the next 2 or 3 years to not get that. And then you can, even if that happens, you can still rent out the chips to someone else. So it just seems like an unbelievably compelling investment. And I think this last week changed all of that, where people now clearly said it. He spent like a whole kind of a few minutes on the call explaining this return. And I think before that, the reason we believed it is some of these companies, Google, Amazon, the like, they've got some of the best CEOs and founders the world has ever seen. It's the largest companies that's ever been built. These people are incredible. And we just had no doubt that they would be making these capex decisions based on very high returns. And the market somehow didn't believe them until they went and explained it last week. And I think that pretty much puts the issue to bed in my eyes.
Maybe just to add there, I mean, I think the back end of this thing isn't just to 2 or 3 companies, it's to hundreds of thousands of companies that are all involved in the US economy. So even though you've got an aggregator there, you've got a massive, massive base of people who have signed up for extended contracts at certain fixed pricing contracts over the medium term. So, it all sort of looks pretty concentrated, but if you go through the whole value chain, you're talking about maybe hundreds of thousands of companies that are actually dialing into this and using these services.
I think the one final point that is very, very important is just on balance sheets. There's a bit of sort of concern in the US markets where you're seeing credit spreads that are widening on incremental debt that's being raised for some of these smaller neo-cloud type of businesses of late, and even for Meta in the last week or so. But the important thing to understand about these businesses, at the end of last quarter, they're all sitting, with the exception of Amazon to a small extent, but like all sitting on net cash on their balance sheet. It's not debt funded. This is funded by the operating cash flows of these businesses. And last week, I did an exercise to try and think through if each of them had to go and get their businesses to 2 times EBITDA gearing, which is similar to what you see out of the likes of a SAB or some of these staples businesses out in the world, which is a very moderate level of gearing, they would have to probably put another $3 trillion into the US economy that would be debt funded. Now, what is that $3 trillion as a proportion of total debt outstanding in the US? It's a number that is close to 15 or 20% of total corporate credit outstanding in the US. I don't know if there's the willingness or the ability of either bond markets or banks to actually go and fund this from a debt perspective. And if that is the case, we're going to see this entire build-out being funded to a very large extent by operating cash flows, which is far more sustainable than a sort of leveraged play over time. So I like very conservative balance sheets, and I'm very hopeful that that's going to remain the case for the next couple of years. And I don't think they can sort of blow their balance sheets up, despite the extreme levels of capex that we are seeing at the moment.
There's a question here just on AI positioning and your view. Do you ask the question to yourselves, what if we are wrong?
I think I mean, this is probably like we debate this for 2 or 3 hours a day, every single day, because every day there's new news, right? There's new models being released. There's stories about kind of who's expanding capacity on the semiconductor side, what's happening. So this is like a constant area of debate in our office, and we have kind of very fierce arguments, and we've always got people taking the other side of it. So I think we've got a very, very strong view on that, but always at the back of your head, you must keep it into consideration, kind of what if we're wrong, or we potentially could be wrong, or let's look for evidence that we might be wrong. It doesn't mean we think we're going to be wrong. You just stay open to that possibility. Now, obviously, when you construct a portfolio, you really can't construct it to both make money if you are right and if you're wrong. So like if we are completely wrong, and let's say AI progress stops like somehow tomorrow, the portfolio is not going to do well. Like if we somehow see kind of that happening, we'll have to reposition the fund, but that is the 100% opposite of what we believe, and clearly what's playing out. I just think there's probably like, I don't know, 95% plus certainty on me that the AI rate of progress continues, and as long as the AI models keep getting better, that whole flow of funds that I put up on the slide plays out, because the better the models are, the more productive they make humans, and the more productive they make companies, the more demand there will be, and then the money will flow all the way through the chain. So that is the key thing. I think on various sectors, there's ways you could be wrong. So let's say on semiconductors, when you look at basically someone that produces DRAM or hard drives, that's a form of a commodity, basically. You always have to look at what's the demand and what's the supply. So the demand is shooting up because there's crazy demand from AI, from companies, from the frontier labs to train models. So we are very, very sure on the demand side. Then you also have to do a lot of work on the supply side, right? To say, can we be wrong on the supply? Can the supply grow faster than the demand is growing? We think what's happened in a lot of these industries, being chips or RAM or hard drives, because it's been a cyclical industry, every down cycle, the industry further and further consolidates. So hard drives, that's one of our big bets, the old spinning disk hard drives. That's basically the core of the storage used in the world. So basically, every photo you have on your iPhone or Android phone, or every video, that's backed up in some cloud to one of these spinning disk hard drives, right? So that data is growing. Obviously, every AI query backed up to one of those hard drives. What's happened there is that industry is consolidated from many, many players over many years down to 3 people. There's only 3 people in the world that make hard drives. So when they see the demand coming, they're going to steadily expand supply, but they don't want to stuff up their own market. They're going to manage that. So hard drives, there's only 3 players. China cannot currently make hard drives. That's quite a nice story for us. The part we're watching very closely is RAM. Again, there's pretty much Hynix, Micron, and Samsung that make like, I think 85% of the world's DRAM, but there is a Chinese player called CXMT. Some of you might have noticed, I think they listed in the last week or 2 in China, so we follow that quite closely. So I think that is the key picture we're watching, is how quickly will the Chinese player expand their supply, and how does that play out versus demand. So I think that's the main area where we potentially could be wrong, is if somehow supply expands very rapidly, and it means like things are not quite as tight as they are now, but by 2029 or 2030, maybe they're slightly less tight, and that means prices will come down. So I think we're clearly very open to it. I think we're very highly convinced we're right in the next 6 or 12 or 18 months, but we're going to stay open to all the facts here.
There's another question implicit there, which is to ask, are we potentially in a bubble? And if you look at the names on the internet side, in particular, the Microsofts, the Googles, the Amazons, where we have very high degrees of conviction, the valuations there are 22, 23 times forward earnings, even after the last run that we've seen in the last week or so. That compares to the S&P at 21, 22, yet these companies are going to be growing at probably 2 to 3x faster than what you see for the S&P as a whole. So I don't think there's any specific valuation bubble with those names in particular. If anything, I think a lot of them are under-earning at the moment, where you look at the compute rates relative to spot rates in the market. And then on the semiconductor side, I think you also, in addition to looking at the sort of price earnings multiples, you also have to ask questions about, are they potentially over-earning at this point in time? And that talks to exactly what Jacques was saying with respect to supply and demand and how you have to watch those key elements. But even with that, the SK Hynix and Samsungs of the world are trading at 3.5 to 4 times earnings, if I'm not mistaken. So, there's quite a lot of margin of safety in the price, with committed contracts into 27 and 28 for sale of these things, which de-risks your entire position quite materially from a valuation perspective. So, but we ask that question every day.
Yeah, so for example, just on valuations, as Justin said, global markets, the US is at about 20 times earnings. I think Europe's maybe 15 times or so. So let's say these hard drives names I spoke about, they're trading at about 20 times earnings right now. They're going to grow earnings way more than 100% this year, more than 100% next year. Even 2028, we think they're going to go close to 100%. So that's just like the market's growing at 10, and you've got these things on the same multiple, but it's growing at 100. TSMC, that's our biggest holding in the funds, trading at 19 times earnings. That's below a market multiple. They're going to grow earnings 70% this year. We think they're going to grow mid-30s kind of for the next few years. And again, the hyperscalers, maybe like a 1 point or 2 point premium to the market, 22 times earnings. For Amazon and Google, we've got 35% growth for the next 3 years. So it's just... I was telling the team yesterday, I cannot remember a time in the fund's history where if we look at the earnings growth of the companies we own and we do like a weighted average calc, like what is the earnings growth of our overall portfolio, it has never been as high as now. So it's quite a unique point in history where valuations are actually in line with history, but we've got the fastest earnings growth we've ever had in the fund in the kind of, let's say 28 years we've been around.
And until last week, I was always a bit nervous on the semis names in particular, because you're spending all this capex. It's gone from, say 20% of your revenue all the way up to like a much, much bigger number. And they're spending 100% of the operating cash flow at this point in time. The question of return on invested capital was one that was absolutely central to the sustainability of that build out. So where I might have been a little bit more nervous on the semiconductors names, historically speaking, I think from a demand perspective, I'm probably more bullish today than I have been over the last 6 months.
A couple of questions coming through, so I'm going to kind of try to paraphrase here, but we've obviously focused on US hyperscalers and US entities in large. What do you think about the Chinese ecosystem? So things like Tencent Cloud, Alibaba Cloud, etc., and then the potential threat from models like Kimi and DeepSeek, etc., to kind of upset the apple cart.
It sort of talks to what David alluded to a little bit earlier, where, what does the breadth of this demand profile look like, and the extent to which these Chinese models can come to market at similar capabilities, but with much, much lower pricing, is going to drive much bigger adoption by a broader cohort of customers, and they're ultimately going to be, there's almost an infinite demand from an intelligence perspective, but a lot of companies are running into sort of caps in terms of what they are actually spending. I know I sort of hit that on Claude on a sort of weekly basis with respect to some of the projects that I'm running. So I think it's very good for the world that you're going to have multiple competitors out there to put pressure on the pricing of OpenAI and Anthropic, so that you're going to get more value for money. But the real end game for me is the extent to which, it's that Microsoft analogy I gave you earlier, where they said 25% quarter-on-quarter growth from companies other than the big model players. That assumes, or that signal is that it's a broad-based demand from real businesses on the ground. So if you've got very cheap intelligence, every other business in the world is ultimately going to be using it and adopting it at a much greater rate. It's that Jevons paradox that everybody has been talking about historically. But in the same breath, I think there's still, everyone talks about these cheap Chinese models, which are fantastic and a threat. Who are they a threat for? Mostly for the American labs, not for the hyperscalers and not for the application layer stuff, certainly not for the semiconductors. So I think the American labs are the ones that were most at threat. But despite that, Anthropic has just hit an $80 billion revenue run rate year on year. So I don't think they see a ceiling in demand despite their pricing being higher. They still are at the frontier. And we have this debate internally a lot about, certain of these models might be very cheap from a token perspective, per token, but they're not as cheap from a per task perspective. So they will burn more tokens to get to the end result and ultimately incur a higher cost in absolute terms relative to some of the frontier models who can just get to the answer with burning a lot fewer tokens. So we're not seeing the Chinese at that frontier just yet, but the extent to which they do come, I think, is wonderful for competition and is wonderful for the hyperscalers and probably for the semis as well.
Yes, so our estimates, they're about 4 months behind the US models. And even though the models are open source, that it's free to download the weights, it still has to burn as much GPU time as the Frontier Labs. So in fact, because the Frontier Labs are smarter, they might have to burn more GPU time to get to an equivalent answer. So for our hyperscaler thesis and the semiconductor thesis, I think it's like neutral. It might even be bullish to have Chinese models out there. And to that great earlier question on what if we're wrong, one of the key things we debated 2 or 3 months ago that was one potential way we could be wrong was, what if the US government gets so scared of these models that they just start limiting releases and they say, okay, you've got to wait 3 or 6 months, or we're going to cap it beyond a certain point, you can't release it, it's too powerful, we don't want it in the public's hands. That would clearly be probably on the list of risks. That could be one of the highest risks that the thesis doesn't play out. I think the fact that China is only 4 months behind with open source, they're going to dump the weights and the models anyway, means practically the US government just cannot restrict these models. They had that 2-week window where Fable was effectively blocked and then re-released, and I think a large part of it is, if China's 3 or 4 months behind anyway, there's just no way you can wait 3 or 4 months. The whole world will then move off US models to Chinese models. That is the extent of our lead. So that, to some extent, the fact that the Chinese is out there, to a large extent, in our opinion, ticks off that risk. So we're obviously going to keep watching the regulatory risk. I just think practically there's no way you can slow down the US labs when it's a race.
And we still have a decent exposure to Tencent anyway, who obviously would be a beneficiary of that with a massive customer base. We've got a decent holding in Tencent.
Tencent's still trading about 12 times earnings at the moment. It's had a very weak year. It hasn't been great, but we are starting to see quite a lot of improvement from an application layer within Tencent. So like the model layer is obviously very, very competitive over there, and you're not really going to make Anthropic-type margins. They do have a competitive model in the Chinese space, but you're starting to see them really leverage things like their WeChat platform, where they're starting to build agentic capabilities into WeChat that assist users to sort of navigate their day, both sort of online and offline. And you're starting to see a lot more transactional activity that is generated on an automated basis using the agentic capabilities within WeChat. So I think they're making wonderful progress, and the share is very, very cheap at this point in time. So we are hopeful that it's going to continue to perform for us in the next couple of years.
Yeah, well, maybe just that, it hasn't worked this year. I think Tencent and Meta has been our 2 biggest losers. Yeah. So that's probably the one where I think that's the biggest mistake, is not seeing somewhat earlier how the market would treat these stocks. And as we explained, semiconductors gets the immediate benefit. Hyperscalers, they've got to spend money, but the moment that money is in, it immediately starts adding value. And then what happens with Tencent and Meta is they spend the capex, then they have to use that capex to build new apps, improve existing services, build new products that you're going to roll out, and then see if you can get users on those and monetize. So clearly it's immediate cash benefit, spend capex, and then pretty much immediate benefit. And here it's some delayed benefit that's going to take 3 or 6 or 12 months, and it's somewhat uncertain. How well will the new app work? How will the kind of new AI models work that you release? So the further you are away from immediate payback, the worse the market has treated you. And I think it actually makes perfect sense with how the cycle's played out. Saying that, after how they've performed and the earnings have kept growing, these shares are just incredibly cheap, especially Tencent at like close to 10 times earnings, which is where a lot of like SA stocks are trading for lots of potential over the next few years as they land these new products.
A couple of questions. So again, I'm going to try to paraphrase here, but the first is in terms of the Peregrine fund profile has normally been a very consistent return profile. So there are a couple of questions about kind of how do you hedge the downside in this current environment. So let's call that the first part. But the second part then is, obviously the semi space is incredibly volatile, and I think this last month has certainly shown us how amazingly volatile it can be. How do how do you factor that into position sizing, into the kind of overall portfolio construction? And then on top of that, are you happy to take additional volatility in the funds because you just see significantly better return outcomes over the next 6, 12, 18 months?
Good answer. Next question.
I think it's Adeline, this is certainly something we debate a lot in the team, is there's always what's the idea, what's the expected return on it, but also what's the volatility and what's the downside if we get it wrong. So there are two things to think about. We always worry about what is the chance of permanent capital loss in a position? What's the chance of us being long, we own something, it falls 30 or 40 or 50%, but it falls like that for the correct reason, and we end up selling it there and moving on because we just got the thesis wrong. So that's obviously, as a fund manager for us, volatility is one thing we've got to manage, but permanent capital loss is the main thing we try to avoid. So in something like the semis, at the prices we get in at, and even at the prices they're trading right now, we think expected return is exceptionally high. At the same time, we think risk of permanent capital loss is very, very low, because even on the RAM companies, at a 4 PE, you basically pay down your whole market cap in 3 or 4 years. So we only have to be right that earnings sustains for the next 3 years, roughly, to be 80% of the share price paid down by that time. So the chance of permanent capital loss here off these levels, not of where they were, end of June, I mean, we wrote in our annual letter, we sold a lot of our non-TSMC semis because the margin of safety wasn't there. At this point, the risk of permanent capital loss is exceptionally low. The expected return is very, very high, but the volatility is also high. And we've made a call that we will accept slightly higher than the volatility we've had in the fund, maybe the last 3 or 5 years, maybe more like we sometimes had 8 or 10 years ago in the fund. Let's accept slightly higher potential volatility in the month-on-month numbers, but in exchange for potentially very, very high expected returns over the next 18 months. So you would have seen March was quite volatile, partly because we had semis in the fund. Last month, I mean, we printed kind of flat or slightly up for the month, but in the month there was quite a bit of volatility in the funds. So that is an active decision. It's not putting kind of permanent capital loss at risk, but it's saying these things could do exceptionally well. We want to have as much as we can in them while still managing overall volatility to a reasonable degree, but accepting slightly higher than we used to in the past. And let's say in the past 3 or 5 years.
I mean, I think maybe another thing just to talk about is previously we have often used option structures or whatever, sort of bought puts in the funds to mitigate some level of vol. How do you think about that in terms of whether it's a good decision to add or not into the fund at any particular time?
So I think we always look for efficient ways to hedge. Sometimes there are efficient ways available, sometimes there's not. So last month, we had this crazy pullback in semis, like the RAM shares fell more than 50%, many shares fell 60 or 70%, the overall semis index probably like, I don't know, more than 30% down. The poster boy of the cycle being situational awareness, Leopold was the fund manager's name in the US, that had a spectacular, literally blew up their listed book and had to be bailed out or sold his entire listed book pretty much at the low point last week. Semis just has its own. It's a very unique period of time where that really has its own volatility profile. It sold off, and this whole fund blew up, and the S&P was down like 4% from all-time highs. So had this guy at S&P hedges, it was not going to save him. Like, it was, the volatility in that subsector is very high, and the only way you can hedge that is basically just selling semis when it gets too expensive, and then having some cash and putting that back in, which is partly why we did and why we had a much smoother month than kind of some of the highly volatile tech areas. So right now, it's trading very much as a specific trade, and I mean, we're going to keep looking for this, but the only way I see to hedge it is to manage exposure, sell a bit when it gets expensive, buy it back when it gets cheap. And if we find a hedge, we'll use it, but I think clearly if what you've seen from fund performances is there's just not been efficient hedges out there for this at the moment.
So I mean, I think, can I summarize by saying we are not long-term holders of these businesses per se. We are very active in trading around where we think there is margin, getting in where we think the margin of safety is high, and exiting where we think it is.
Yeah, correct. I would see we see them as tools to make a lot of money for investors, and I think over the next year they're going to be great tools to serve that purpose. But it's not like we're in love with these companies. The fact that we sold 80% of our non-TSMC holdings in 1 month in June when they got there just shows you how we will behave when we think they get to fair value. But saying that, I think it worked out fantastically because we could basically rebuild that same size, actually slightly higher positions at probably 30% on average lower entry price than where we sold. So I think if we're right and they go back to all-time highs at some time over the next 6 or 12 months, it's just going to do spectacularly well.
It's also important to mention the fact that of the semis book that we're running at the moment, more than half of it is this TSMC position that Jacques keeps referring to. Now, go back to what I really like. It's a business with, it's basically a monopoly in that sort of chip manufacturing space at the high end. It is trading on 20 times earnings and is expected to grow its earnings base by north of 30% per annum for the next couple of years. And that is a business we absolutely love. There are some competitive threats that we have to keep our eye on from a supplier perspective, but on the whole, that is the one that I think is the most defensive from a business model perspective. And then, it's this other 40% of the book, of the semis book that we're referring to, being the memory names and the spinning disks and those sorts of things that we've got to be a little bit more cautious on and sell a little bit closer to the exit when valuations get ridiculous or a little bit more expensive like they did at the back end of June.
I think having said that, we are aware of the volatility, and obviously, we see it. We're a lot closer to than you guys are. But I think it is just one of those market movements right now. The debates are very much headline news for everyone. Are they spending too much? Will they ever get a return? So I think while this action is here right now, and as long as we are consistent with our view and make sure that we are correct and keep back testing our thesis, I think it is a very exciting time to sort of trade these things. And we also want lower volatility than you, but while this situation is here right now, we are trying to take advantage of it as much as we can. And bear in mind, we're not talking about small cap companies here that are not liquid. These are huge, trillion-dollar companies that are quite easy to trade in and out of. So at least we're in liquid sectors and we are able to get in and get out as we feel appropriate. So I think we're just going to have to...
So if I maybe speak about our SA book, I think the moment the war started, we identified oil as being the biggest risk to our SA positioning. So what we did at that time is for various periods of time during March, April, May, June, we used a long oil position to hedge the performance of the SA book. And at the end, the oil position broke roughly even. But what it did is it smoothed the volatility. Like when oil ran, you made money in the oil position, SA shares are down, that neutralizes out. So I think it was a nice, basically at zero cost, you lowered the shock and up and down on the SA book. And just in the last few days, kind of oil kind of 80 or below 80 again, we started putting a little bit of that hedge back on to say, clearly SA banks and things have run nicely now. If oil keeps coming down, maybe you lose a little bit there, but we're going to make way more in the funds, and it's a nice potential hedge for if things escalate again. So I think we keep looking at what's clever, cost-efficient ways to hedge the funds while not bleeding a lot of cost on option premiums and the like.
Then a couple of questions here on the kind of SA exposure. So first question is, besides obviously a de-escalation or a resolution in the Middle Eastern conflict, what other domestic indicators would give you confidence to increase your SA exposure again? And then the second part, Dave, I'm just going to keep going, is which particular opportunities are you looking at in terms of South Africa? What are the things that are kind of on that buy list if you start seeing these indicators move?
Look, obviously we're going into regional elections towards the end of the year. That obviously becomes quite volatile and quite interesting. Be interesting to see how that sort of plays out. We could see the ANC lose both on the right and the left wing, so it could be quite interesting to see how that sort of pans out. That is obviously a thing we're tracking quite carefully at the moment. I think the SA balance sheet is still in a reasonable position. We talked about windfall profits from precious metals of 50, 60 billion when we sat here in February. That's probably nearer 10 or 15 or 20 right now than the 60. So we still think the SA balance sheet is in reasonable shape, but obviously not as good as it would have been if we'd first of all maintained our precious metal levels and obviously offset somewhat by the oil shock. We kind of back to where I think we kind of muddle along in South Africa like we have been doing over the last 5 years, unfortunately. Probably still a lack of investment, still a lack of job growth. So what are the signals we're looking for? Well, certainly oil and the resolution of the war would be the single biggest factor, and we could see oil sort of get back to sort of the 60s, 70s. And I think more importantly, the refining margins that have, people look at oil, but they don't look at the refining margins. Oil, for example, at 80, the diesel crack, which is effectively the margin to convert that barrel of oil into diesel, actually peaked last couple of weeks ago at close to $90. Now, generally, that sits at about $25 normally. So, something like diesel, which is obviously, drives a lot of the economy, both in logistics as well as private consumption. That's quite a significant, cost, and hopefully that starts coming down. And if those things start coming down together, hopefully we can see a slightly better story for SA. I think that the targets in SA right now are very specific. We're looking for AT management teams, the outsurances, the people who are executing well at the moment, who we've got history with, who will kind of eke out whatever's out there in South Africa. We certainly don't see any major sort of themes emerging out of SA. The retail market is under quite extreme pressure at the moment. But, I guess those valuations have come down quite significantly as well. But they obviously are a recipient of the spend being diverted away from, I guess, online gambling would still be around, and that's one of the issues, as well as the petrol price. So, retail something at the moment we're pretty muted on, although the shares have drawn down quite significantly. So we'd like to see just a little bit more confidence back into this economy. But at the moment, from what we're seeing from SA companies operating, is it's particularly hard out there at the moment, and there really isn't any great stories. I think the xenophobia has also been quite a big issue. A lot of people have destocked in anticipation of the marches. I don't think it's particularly positive for SA. I think there's a lot of dislocation of labour that's happening at the moment. So I'm not sure that's really a great story for South Africa. And I think at the margin it's probably slightly negative. Once again with South Africa, there's never really a stable situation. There's always lots of moving parts. But I guess to see companies starting to talk to us about demand stabilizing or demand starting to pick up would be a sort of sign, but we're certainly not there at this point.
So I'll just add to that. I think a scenario where the precious metals resumes this uptrend would also add to the SA picture. And maybe that happens if the war ends, but it could even happen regardless if the war just ticks along in some stable state, because that obviously improves the budget deficit, it improves the rand situation, it leads to lower inflation, lower rates. So that is part of what kicked the story off last year, and I think that's certainly another positive that we'd watch out for that could get it going again. But as David said, this is really for like the incremental part of the book, where maybe you take some SA almost retailers or just additional banks exposure to benefit from foreigners coming to SA. Regardless of that, like OUTsurance, we kind of bought back a very meaningful size position. I think it's probably the largest position in SA now. Share was just flat for 12 or 18 months. The company's delivering. In the insurance space, Momentum's actually a really good story right now. Management's delivering. They've been investing in this little Indian healthcare business that's not so little anymore. It's done exceptionally well, and we think the market's missing that in the share price. Discovery's been a good one for us. We trimmed some of it. It's just had a great run, but also they've got like an economy-independent growth story. So there's a fair amount of economy-independent stories we can find, but for let's say the macro bet on SA or the real juice to happen, you probably need some of these scenarios Dave described to come through.
Yeah, and I think in February the foreigners were set to come. There was no doubt if we maintained our situation there, the foreigners would definitely start coming back into our market, and that's what's going to take our P's from the normal 10 back up to the 14, 15s. And I think at that point in time, that's really where we positioned ourselves. Once we realized the war was on and obviously petrol prices were set to rocket, we had to sort of re-look at that view and pare that position back quite quickly. And again, I think we have again fallen off that radar screen. Just speaking to someone from Morgan Stanley last week, we're just a rounding error in the world right now. There really isn't anyone who is really excited about investing in South Africa right now. And that's, a lot of that's us. We need to get this economy going. We need to get GDP up. We need to get job creation up. And although I think things like Operation Vulindlela are making good progress in a lot of areas, there's still a lot of resistance, on many fronts to really get this to become a market economy where we can really start looking at 2 to 4% growth rates again.
Quite a nice question here, maybe just for feedback from kind of management meetings with SA teams. How have you seen SA companies' adoption of AI relative to kind of what you're seeing in the bigger S&P 500 names?
Look, we're asking everywhere we go. I think there are a few companies. I think, like my sense is Capitec is really trying to move fast on this. Maybe in the bank space, I think FirstRand's trying to move quite fast. But inherently, large companies will be conservative on their speed of movement. They have to think about like customer data and what's the cost if something goes wrong and the like. So I think South African companies will move somewhat slowly to implement this. So in terms of looking for real businesses in like listed SA companies that'll have a meaningful benefit on AI in terms of their share price, we have not found any of those yet, and I think it's probably still some time. It just will take a while to get people out there. Like even in our business, we've been on a really hard drive the last 9 months to get everyone to just obsessively use AI. Almost everything you do, think about whether you want to chat to AI about it. And even there, I think we're there now, but it takes a while. Obviously, we're for a really small business. If you're a 30,000 people company, like a big bank, it's going to take you a while to get this embedded in the company.
And then maybe just a couple of questions coming through here to say, what's our exposure to the AI theme as kind of a percentage of the fund? And I'd suggest we break that into what's our exposure to kind of the semi side, what's our exposure to the hyperscaler side, and then also what are the other things that are making up that portfolio in terms of the buckets?
So broadly, if you look at the overall fund, we're about 60% or 70% net exposure right now. Of that 70% net exposure, 45% of the net is AI and AI related. So it's almost, obviously there's shorts in the book, so you can't just say it's only 25 and the rest. We've got index hedges and the like, so maybe we're like 100% gross long. But let's say of the net exposure, more than 60% of our net exposure is in AI, and that's broadly equally split between semiconductors and the hyperscalers bet. So as I said, in the first half, the days the semiconductors were up a lot, you lost a bit on the hyperscalers, and the day where they were down, you made money on the hyperscalers when the semis were down. I think with the info out there right now, we've seen this for a few days in markets now. I think we're in a situation where both are going to work at the same time, because it's clear the semiconductors will make a lot of money, but it's also clear that money is going to deliver great returns at the hyperscalers. And I think that dam wall broke kind of last week. So I think it's highly likely that both of these buckets do exceptionally well. And I mean, we spoke about the growth rates. Let's say that hyperscaler bucket, we think earnings grow 30% plus, and the semiconductor bucket probably faster, maybe 40-50% on average, if I blend TSMC's growth rate with the other growth rates. So both of those buckets kind of on a 30 and 40% respectively on earnings growth rates. So even if there's no change in ratings, that's almost the expected returns you could see. But I certainly think on the hyperscaler side, I'd bet that they are going to be on a higher P in a years from now. So I think you're going to do better than the earnings growth with the return on that. And obviously, let's say there's about 30% net in SA that I spoke about, and that includes maybe a little bit of mining. And then offshore, we'll have various other kind of interesting positions. Interactive Brokers is a business we like, and some other things, and index shorts. But to make it clear that those are some of the, like, let's say, big bets that's easy to see as buckets.
And then a couple of people asking for your thoughts on SpaceX.
So it was a real fun one for us to try to trade. So we actually thought it was very likely that post-listing the share would do well. It was just so well marketed. It was like all day on all the kind of major markets channels. So we actually went in for a very big application to get shares at the IPO. And unfortunately, we did not get any preference. The fact that Elon's from SA did not make any difference with how much we got. I think we got like 1% of our allocation we applied for. It was obviously a hotly contested IPO, and typically these things, if it's a US IPO, the large US clients that's close to the banks running it get the majority of the allocation. We did our best to ask, but only got a little bit. Obviously that did very well. I think we'd ran from 135. I think we sold at like 185 on average, so like made maybe like, I don't know, 35-40% in 2 weeks. And the view up front was just because they're only listing 5% of the company, all the retail investors would be kind of excited given all this marketing, and they just see SpaceX everywhere, and it's the only way you can get exposure to like Mars and space data centers. The story is just fantastic, so you just knew retail would buy up front. So we sold out kind of, we were just in it for now just for a flip, sold it out, and then I guess the reason we didn't want to own it is this share has made so many people so much money. Like all the staff, anyone that worked early on SpaceX is either worth $10 million or $50 million or $100 million. You just got shares for very low, and it did like 100x. So there's this huge wave of selling to come. Starting, I think it's kind of the first week of August, which is this week, that the shares start unlocking. So up front, no one could sell. They only sold the 5% in the IPO. No one else could sell their shares. So that's why we thought it was going to go up. Very few sellers, a lot of buyers. Now, you got to think, if you're a staff member there, or if you're an early SpaceX backer, and like 90% of your net worth is in SpaceX, you're certainly not going to buy more. Most people are going to say, okay, I'm probably just going to sell half and put it in the index tracker, or put it in with a fund, or put it in markets. So you're just going to have this wave of selling, and I think that's what the market's scared of now, is they know this wave of selling is going to come over the next 6 months as these shares unlock. So we actually, I think we went short at, like, I don't know, somewhere in the 150s. Unfortunately, we should have gone bigger, fairly small short, and we still got the short at the moment. It's probably something, it's just a tactical one where it's based on more sellers than buyers. Maybe someone in the next few months will buy back the short. And then towards the end of the lockup expiring, we will think about this as a potential long opportunity. It's just, I don't know, we're not brave enough to buy it into this giant wave of selling. If 30 or 40% of the shares will be dumped on you by various investors, that's up 100 times. I think it's just too risky to stand in front of that sell wall, and let's first see how things look post that expiring. But it's a really nice share to have part of our universe now. We've got someone, I look at it with Eric, one of our analysts, we're going to cover it, we're going to look at it, hopefully there's more opportunities to make money from the share in time.
So just maybe tell us about your model. How do you value SpaceX? Because it's kind of like we've got these satellites, and then we're going to launch stuff to Mars. I mean, it's quite difficult to model that bad boy.
Yeah, so look, mostly we're value investors, and all these semiconductors and hyperscalers, we've got firm models with cash flows. This one, you also got to be smart enough to know when the model doesn't matter for now, and it's just trading the story and the flow of funds. So we do have a kind of model, but let's not pretend that that's what's driving the share price for now. The share price is being driven by retail demand, buyers and sellers. I mean, that's also Tesla. Tesla's never been driven by some DCF model. It's like how many people like Elon and want to back Elon and own Tesla. So Elon's universe, you got to have a different mental model than a pure spreadsheet DCF value investor here. I think in time, if we think data centers in space could work, we're very unsure about it. It's very expensive to send the stuff up there, and then after 5 years, the kind of satellite just decays and crashes back into Earth. So I think that first has to be proven out. So we will build a model, but in the short term, you got to be honest with yourself, and the model wasn't going to drive the share price. It was going to be how many buyers and how many sellers are there.
I found it very amusing when all these US fund managers were out there telling you about, they've got Elon Web Services, which is going to compete with Amazon, and they've got this foundation model that is at the Pareto frontier. But both of these things can't be true at the same time, because in the event that you had this amazing model, you wouldn't be selling your computer externally, right? So, like, how do you square that circle? And now all of a sudden, instead of focusing on all of the space launches and how they're going to make amazing money from Starlink, they're saying, it's actually going to be an AWS type of business going forward. And the next thing is data centers in space. So maybe I'm just getting grumpy and old as I see too many of these things. But it's very difficult to make any sort of fundamental bottom-up type decision on that thing. And as Jacques said, it's exactly the same with something like Tesla. But it's...
Look, I think Elon is just amazing for the world, and it's epic for the world to have this company out there to get space, get people excited. My kids love watching the rocket launch video. So it really is awesome to have this there and to have someone dreaming about Mars. I think it's fantastic for the world. So I indisputably love Elon and SpaceX and what it does, but then obviously buying the share is different. That's for us, is it a tool that we can make money off or not? So it's almost separating those two views.
And then a couple of questions just specifically on the pure hedge fund, and kind of maybe you can just talk to the factors impacting the performance there for the year to date.
Yeah, so I think there, as I said, it hasn't been the best year. Firstly, I think the environment was slightly tricky for us. And as I said, we got semis right, but unfortunately we got this hyperscaler bit wrong. So our alpha has not been spectacular over the last 7 months. It's been below where I would have liked to see it. And as I try to explain, it's not a permanent capital loss. Like, we own all these things. We've actually bought a lot of them, a lot of additional exposure in the last month or so. So we are very excited about where they're going to end up. And it's very similar. So like growth, maybe where we're standing now, growth is up like 3% or so, kind of live, maybe Pure Hedge up one a little bit. It's really the same thing that's impacted both. Pure Hedge, it's more pronounced because obviously in Pure Hedge we run lower net exposure and we've got index hedges. So we've got a similar long book, but we've got index hedges, and some of those offshore index hedges have hurt the performance, and that's probably where the few percent difference to high growth comes from. I think both of these will resolve very quickly if we are right on our thesis for the second half on how both the hyperscalers and the semiconductor shares will start performing. Because frankly, in the first half, the blend of exposure we had, semis obviously way outperformed the indices, but hyperscalers were down in a market where offshore indices were up. So I think as a blend, we didn't outperform the index hedges, and as such, that's why there was kind of very limited alpha or very limited returns in the first half. So it's basically, we just got to be right on our call for the next 6 months, and it resolves. But that largely explains, or that's the reason for the very muted performance year to date.
Yes, I think going forward, instead of having a winner and a loser, we hope we just got two winners. I think that's the kind of the thinking where we sit right now. And unfortunately, the money seems to have flown from one to the other every second day. So they're just, it's either the hyperscalers are hot today or it's the chip stocks, and the money just seems to flow between them. But hopefully now the market can start seeing there's a way forward where both can actually move forward together.
Yeah, and look, to just tell you how I see it personally, I mean, there's been times in the past where our drawdown is we got something wrong. Like I always think back at the time when we had very big exposure to China in 2021, and China completely changed the regulation of the tech companies, and these tech companies fell like 60% or 70% from the peak to where they are. Like we figured this out somewhere halfway and we sold them 30 or 40% down, but that was a permanent capital loss. We ate a 30, 40% drawdown, we sold them out. Another example would be we were big backers of kind of there's the Beers group of companies, Resilient, Fortress, Green Bay, a bunch of those. This was back in 2018. Many of you would not have been investors back then. We did very well out of them for a few years, and suddenly the story changed, and these things fell 30 or 40% on a day, and we actually had to sell every single share even after that pullback. So that's a permanent loss. It's also fun. We just kind of move on. You go make it back elsewhere. This is much less bad than that because I think it's a temporary drawdown in shares we really love, and I think you're just going to make that back and then some if we're right over the next 6 or 12 months. And personally, my personal portfolio is very boring. I largely just have cash and then very big investments of almost all my net worth in the funds. And I've made by far my largest ever fund investment as at end of July. I just think, as I said, there's never been as high earnings growth embedded in our funds. So I just think versus I always have some cash, but the vast majority of my offshore cash I put in the funds. I just think it's absolutely compelling, these valuations right now. And as Dave said, we just think both legs of the thesis are going to work in the next 6 or 12 months.
Great. I think I'm going to leave it there. That was lekker. Thanks, everybody. I think I've gotten through most of your questions, but if I haven't, grab me. I will hopefully give you a relatively decent answer after this. But thank you all so much for joining us. Really appreciate your time. Hope you found it useful. There's some lunch outside if you can stick around, but we really appreciate it. Thank you.